ESG covenant clauses made clear. Capital Markets English Toolkit. Welcome. In this micro lesson, we turn ESG drafting tools into clear, compliant term sheet clauses you can plug straight into a deal. Our focus is plain, precise legal English that survives negotiation and scrutiny. If you draft for capital markets, bonds, loans, or structured products, this is for you. You'll leave with ready-to-use covenant language and a method to justify it to counsel, arrangers, and issuers. We'll define scope, set KPIs, lock in reporting, and tie outcomes to pricing without fluff. Let's make ESG terms enforceable, auditable, and easy to read. Start by saying exactly what E, S, and G mean in your deal. Specify the metrics you'll track, such as Scope 1 and 2 emissions, injury rates, or board independence. Cite recognized frameworks, for example, TCFD for climate risk, SASB for industry metrics, or ISSB for global baseline reporting. Set materiality and boundaries. Which entities, geographies, and operations are included or excluded. Replace vague claims like sustainable with defined terms and measurable indicators. The earlier you pin down scope, the fewer disputes later, and the easier assurance becomes. Pick measurable, auditable KPIs that match the issuer's business and data maturity. For each KPI, state the baseline, e.g., FY 2023, the target, e.g., 20% reduction, and the timeline, e.g., by December 31, 2026. Explain the methodology and data sources, emission factors used, consolidation approach, and any exclusions. Build in rules for restatements, if historical data changes, and recalibration, if acquisitions or divestments materially shift the baseline. Example: if the KPI changes due to a mandatory accounting revision, the target adjusts proportionally, certified by an independent verifier. Precision prevents gamesmanship. Lock down reporting so investors see reliable, comparable numbers. Set frequency, e.g., quarterly updates, annual assurance report, and define format with templates and data tables to avoid free-form narratives. Specify assurance, internal review for quarterlies, external limited or reasonable assurance annually, naming the standards used. Grant information and access rights so verifiers can examine records. Include a cure period for late reports, e.g., 10 business days after notice, so timing issues don't trigger immediate default. Clear reporting rules turn ESG promises into verifiable performance. If the deal is sustainability linked, connect outcomes to margin or coupon. Define observation, when performance is measured, and testing dates, when pricing changes apply. Use step-up/step-down caps so pricing moves are meaningful but not distortive, e.g., plus or minus 25 bits per second total, applied in 5 bits per second increments. State how partial achievement is treated and how long pricing effects last. Add a fallback if a KPI becomes illegal, discontinued, or irrelevant. For instance, switch to a pre-agreed substitute KPI with independent confirmation. Transparent mechanics deter greenwashing and keep incentives credible. Draft obligations cleanly. Use positive covenants, do X, publish report, obtain assurance, and negative covenants. Don't do Y, change methodology without consent. Set materiality thresholds and de minimis levels so minor variances don't trigger breaches. List permitted transactions that won't count against KPIs, like mandated asset sales, and include force majeure for events outside reasonable control. Address change in law and taxonomy updates. If rules shift, The parties agree a good faith amendment to keep intent intact, documented by an independent expert if needed. Clarity now avoids litigation later. Separate timing issues from integrity issues. Provide a grace period and notice for late reports or minor calculation errors. Distinguish events of default, e.g., deliberate misreporting, refusal to obtain assurance, from pricing ratchets for missed targets. Clarify misrepresentation versus calculation error. The first may trigger default, the second requires correction, and, if relevant, backdated pricing. Specify dispute resolution, expert determination or arbitration, governing law, and the court venue. Clear pathways for remedies keep investors protected while giving issuers a fair chance to cure. Keep clauses readable. Use short sentences with one idea each. Define terms once in a definition section and use them consistently. Avoid double negatives and unnecessary jargon. Write must instead of shall not fail to. Add examples next to KPIs. Target: reduce Scope 2 by 15% by FY 2026, measured against FY 2023 market-based emissions. Place calculations and methodologies in schedules so changes are trackable. Test every clause. Can a reasonable reader apply it without guessing? If not, rewrite. Plain English reduces negotiation friction and enhances enforceability.